right, good evening, everyone, and welcome to the third session of the Money Smart for Small Business program. My name is Katie Vandergrift, and I'm the Director of Marketing and Research for Commerce Lexington Economic Development Team. First, I would like to thank our sponsor, Community Trust Bank. They've been a great partner for the series, and they are continuously a champion for small businesses for the last 15 years. So thank you, Community Trust, for sponsoring this. Now I'd like to introduce our instructor, Shawn Rogers. Shawn is the owner of Ascend Business Consulting and has a passion for helping small businesses succeed. She believes in the power of knowledge and will utilize her 17 plus years of experience in small business and economic development to arm her clients with resources for success. So Shawn, I'm going to let you take it away.
Nice. Thank you so much, Katie. Appreciate it. Tonight, as we go through the materials, please feel free to chime in, ask any questions. I feel like the topic tonight, the organizational types, is really important because it's really a foundational piece for your business. And even if you're already in business and you might already be functioning as a sole proprietor, we will talk about that in terms of what some alternatives could be for you. And we'll talk through, the different entities that are available, kind of what they are, pros and cons of each, and some considerations around tax and liability considerations for each one of those entities. And the first thing I would want to say, and you'll probably hear me say this quite frequently, is that I really encourage small business owners to develop an advisory board. And so with that advisory board, I recommend having an insurance agent, an attorney, a CPA, and those trusted advisors. A banker is a key part of that as well. So those become your trusted advisors. And so at the time in your business when you're thinking about how to legally structure the business and what's best for you, and with your personal considerations and how the business is going to impact you from that personal perspective, and minimizing your liability exposure, that's a great time that you want to pull in that advice from a CPA as well as an attorney. So the attorney is going to be looking out for you from that legal perspective, and the CPA is going to be giving you some information and advice from a tax perspective. So I just want to encourage folks to cultivate those relationships so that you can turn to them for trusted advice. But we'll dig right into the materials tonight. Looking ahead, so next Wednesday, the topic is going to be financial management. And so tonight, we're kind of laying a foundation, and the foundational piece tonight is going to be that legal structure. And so we'll build on that next week, looking at financial management for the business. And so we'll keep progressing from there. But kind of getting into the meat of the matter tonight is that when we look at, we're going to look at the general characteristics, advantages, disadvantages for the common legal entity types. And so we'll touch on the limited partnership, but we're going to spend a lot of time talking about sole proprietorships, partnerships, limited liability companies, and corporations, both C and S corporation options. So we'll touch on all of those. Those are the major areas that folks, that they tend to gravitate towards whenever they are starting a business. And what I would say is just a reminder that you'll have a participant guide. If we haven't already emailed that to you, we'll be getting that to you. And that has some really good assessments in it. It has a pre-assessment that you might want to go through. And it's a great tool to help you kind of assess where you're at. And after the class, you can revisit that to see how that's changed, and it'll help you focus on areas that you might want to spend some time or attention working on. So just keep in mind that participant guide is really helpful. And my goal in the approach to doing this is to kind of pull out the key points, and you'll have some supplemental information in the participant guide as well. But as one thing I want you to think about is what do you know, or what to learn about organizational types for small businesses? So that's one question I would like you just to kind of think about as we approach this. We're asking everyone, please chime in with any questions at any time. It's completely open to dialogue and questions, but our intention tonight is to really give you some information and to answer any questions that you have, and then we can follow up with you if any additional questions come up after tonight's session. And we've got one person who's going to be joining us, so I'm happy about that. So thanks so much for being here with us tonight. So we're really just getting started. We're going to be talking about the different legal entity options that are available for small businesses. And so, so I touched on the 5 common organization types, and we call those legal structures. And with that, what we mean by that, it is the option that a business can select when it is organizing. And there are several factors that go into your decision about what type of structure or organization type is to your advantage. And as you think through some of these, you'll kind of see with the taxation, how the CPA can help you think through what are the advantages for you from not just a business perspective, but also from a personal perspective, because the business activity will flow into your personal activity. So we want to make sure that we take into consideration taxation and that impact on your business, on your individually. Because typically with most of these structures, they're pass-through entities. So that means that the profits and losses of the business flow through to the individual, and they end up on your personal tax return. So, so we want to think about the personal tax returns, and of course we'll talk about corporations, which are taxable entities, but we want to give some thought to taxation, definitely liability and risk. And so this is where the attorney comes in to give you some insight into, helping you assess the liability exposure with your particular type of business. It could be, when advising small businesses, I talk to them about what is the core business activity that you're going to be doing. And if you're going to be dealing with people in any capacity, whether those are adults or children, or if you're making a product, or if you are serving or selling food or beverages, I encourage folks, there's more liability exposure with those types of activities, as opposed to maybe having a business where you might be doing like Pampered Chef sales, that type of thing. It's a different type of exposure. So a lot of this comes down to also your comfort level with risk and what your risk tolerance is. Some people are risk adverse and they do not want to have a lot of risk exposure. So they're going to really try and minimize the liability exposure that they would have personally as a result of the business. And so when we get into talking about the different legal entities, that's one of the things I'll be pointing out to you to let you know, will this business activity in any way carry over and affect you personally? We'll talk about what that looks like for each one of the entities. And so on the risk side of things, what we would want you to do is have a conversation with an insurance agent. And so that risk assessment is very helpful, because the liability exposure that you have can be mitigated with insurance. And so we want you to think about what's the ideal insurance for you to have for your particular business. And so an insurance agent is, very well versed in what's available and how to minimize your risk exposure. The other issue I want you to think through as the factor affecting the organizational type is the management of the entity. How involved do you want to be with the day-to-day stuff? And then how do you want decisions to be made? And if you have partners or others who are going to be in the business with you, think about who has decision-making authority, and kind of think through, what that looks like for your personal considerations, as well as the business. And so an example would be if you're going to create a limited liability company, and perhaps it's going to be you and another person, you'll want to decide if you're going to want to decide how the business is going to be managed. Is it going to be member managed or manager managed? So you'll want to give some thought to that, as well as, you'll create an operating agreement at some point, and think through, at what point do individuals need to, do they have purchasing power up to a certain point? So there's some decision-making authority that you'll want to think through. You'll want to consider how your comfort level with that. And that's something that's negotiable as well if you are in business with another person. With each one of these entities, there's the consideration around continuity of the business and transferability. Some of those cease to exist when the business owner passes. Some can be sold or transferred. So we'll want to think about that. So we want you to begin with the end in mind and think about, where you want your business, where you want the business to go. And so, and then finally, another consideration would be, what is the expense associated with this particular legal entity? Will it require a separate tax return? What does it cost to set it up? How complex is it to maintain? Is it going to require a lot of effort on your part, a lot of administrative effort just to keep the business going and address all of the legal concerns to keep it going in a legal going concern? So we'll want to think about how much formality is around each of these legal entities and what type of exposure you have, as well as what potential costs that you would have as well. So those are some of the factors we want you to think about as you think about what is best for your business. And what we're going to jump right into is we're going to go into just a discussion point, or something that we want you to think about would be, as you think about these organizational factors, you individually in your particular type of business, what I would want you to do is really think about the ones you want to focus on. And if there are any that cause you any concern or you have concern around, that's definitely when you're going to want to engage with one of those professional advisors that I mentioned. And I'll just open it up to ask, does anyone have any questions, or does anyone want to share information or considerations of the factors and the organizational types? And you can unmute yourself. And also, if any questions come up throughout the night, please feel free just to go ahead and ask any questions that you may have.
Everyone
Not here.
I was
Go
going
ahead.
to say everyone should be able to unmute themselves, but if you have an issue, just send me a message and I'll make sure to unmute you.
Thanks, Katie. So we'll go ahead and move into the first organizational type, and that is a sole proprietorship. And sole proprietorships are absolutely the most easy business to get going and to set up. And it's actually the business and the owner are one and the same. So there's no separation between the business and the owner. And it's actually the most common legal entity that's going. So there are a lot of sole proprietors. If they can be formally organized, and with a sole proprietorship, it's a local filing. So you do not register the business with the Kentucky Secretary of State. So that is a local filing with your county clerk's office. And so with that, in terms of the name for the business, what you would want to be thoughtful about is, locally, does anyone have the name that you want to use for your business? So that was one of the things you'll want to think through. Also, you would want to go, even though you're going to be local and you're not filing with the Secretary of State's office, one thing I would want you to do is, when you're thinking about creating the sole proprietorship, go ahead and go to the Secretary of State's website and check name availability. So look at the name that you want to use and see if anyone in the state is currently using that name that has a different legal entity. So for example, sole proprietorships aren't registered with the Secretary of State, but all other legal entities are. So if you have a really great name for your business as a sole proprietor, and you later decide to create one of the entities that we're going to talk about tonight, what you would have to do is register with the Secretary of State. And if someone's already using that name, then that's going to complicate things for you. So definitely think about not just where you are today, but where do you want to be, 3 years from now, 5 years from now, even down the road, and think about, for your business to grow and scale to the capacity that you want, what are some things you might want to put in place? And so that would be one thing to consider. It's so important. It's such a foundational thing to the business name, but we want to make sure that if you're available, that it's available for use, not just locally, but also if you do decide to create one of the more formal entities that we're going to talk about. So with the sole proprietorship, if you talk to an attorney is going to tell you, they're going to be like, oh no, you don't need to be a sole proprietor, because there's unlimited personal liability. So even though you're going to have a really great insurance policies have an upper limit on them. And so if something, were to happen and you were sued and there was a judgment that exceeded the upper limit on the policy, that becomes a personal liability to you as an individual. So for that reason, most attorneys are going to advise against a sole proprietor. And so that's where I go back to looking at those organizational factors. and the liability and risk. And so that's where we want to think about the activity that you're doing, how much risk exposure that activity exposes you to individually, and as well as your risk tolerance. So if you feel like that you can tolerate the risk, you've got insurance to shield yourself, then you might be comfortable being a sole proprietor. So all of the businesses except for the corporation are going to be pass-through entities. So this is the first one that we're going to talk about. So what this means is that as a sole proprietor, that the profits and losses from the business are going to flow through to you individually. So the business itself is going to file a Schedule C, and that Schedule C is going to feed into your tax return. And so there's that's how it connects to your personal tax return, and that's how the profits and losses from the business impact you personally. And so with this particular entity, really it's a low cost way to get into business, and it's great for startups. Even if you want to, I've worked with businesses before who start as a sole proprietor, and they have aspirations of later going to a more formal legal entity. So that is definitely something that you could do, but it really is an easy way to get into business. In terms of the continuity and transferability of this business, unfortunately, whenever the owner of the business passes, the business would cease to exist. However, the business can be sold, so the business assets could be sold. So the business itself, with the owner passing, the business would stop, but the assets of the business would be available for sale. So that's a thought about disposal of those assets, and something to consider. And so again, this is one of the easiest forms of businesses to get started. I don't want you to think if you do start off as a sole proprietor, you forever have to be one. That's not the case. You can go into a more formal entity if you choose to, but just know that this is a great way to get going, and you always have the option of choosing something more formal or more structured if that's something that you want to do. So the sole proprietor is one person. So a general partnership is two or more people. And so this is a situation where each of the owners have personal liability from the business. And so with this, you can be personally liable for the business decisions of your partner. So for example, let's just say that your business partner really still thinks that yellow page advertising is the way to go. And they have decided to purchase advertising on the back of the phone book cover. And so they think that's still the best way for you to market the business. And you may think that's just not at all right. So you may be at odds with them over that. If the partner signs the contract and takes out that and chooses to take out that advertising, and it's a contract, they bound the business by signing the contract. So that individual has the ability to enter into agreements, to enter into debt, and that could affect the business. And so even though you may not agree with it, that's just something to be aware of. So whatever the activity of the business partner, it does bring additional liability exposure to you individually. So the owners do have personal liability. How do you prevent that from affecting you? A partnership agreement. So absolutely, if you think you want to be a general partnership with someone, definitely you're going to want to have a partnership agreement. And in that partnership agreement, we're going to want to touch on things like decision-making authority. At what level of spending does a person have discretion to spend dollars to? And when does the other partner need to approve or sign off on the purchase or spending of money? So there are things, as well as decision-making. How are you going to arrive at decisions? And that is something that I recommend working out on the front end while the relationship is still really good, because these are things that you can talk through and negotiate. It's very hard to do that if you get into a situation where one of those issues have to be addressed. And so with a general partnership, it does, you have the advantage of having another person in the business, the shared risk, shared cost, and, it's still a relatively simple type of business to get started. But the downside really is that, how do you feel about that? So it all goes back to liability and risk exposure. How do you feel about that? And so For those reasons, generally my suggestion to small businesses, if you're thinking about doing a general partnership, I would encourage you to consider doing a limited liability company. And we'll talk about that in just a few minutes. But with a general partnership, again, it does have advantages, but the things that concern me are what I talked about earlier in terms of the other person's ability to bind and enter into legal agreements that tie the other business partner to the project. So for those reasons, I'm not a super big fan of the general partnership. With this particular entity, it is a pass-through taxation. The entity itself files a tax form called a 1065. The business will not pay taxes. That tax return is just informational and it's for the IRS. So it lets them know each partner's distribution of profits and losses from the business. And so that's kind of how the taxation works with the general partnership. The next entity is an interesting entity, and it's a limited partnership or limited liability partnership. And one thing I want to mention is an entity like this or the limited liability company that we're going to talk about in a few minutes are all based upon state law. And so if you find this to be an interesting way to start your business or an interesting approach to take, you would definitely want to check locally to see with the Secretary of State to see if this type of legal structure is limited to certain professions. And an example would be sometimes entities are limited to or only available to like professions such as physicians or dentists or architects. And so what you would want to do is to find out if your particular business activity, if it would be able to file as this type of organization or structure. So with the limited partnership and the limited liability partnership, the intention really is the investment from the partner is limited to what they have put into the business. And so they're going to rely upon a general partner to run the business. This is almost like someone investing in a business. They want to be a silent partner. So they want to put money into the venture, but they do not want to be involved in the day-to-day stuff. And so they're going to look to that individual to run the business the day-to-day. This does require a partnership agreement. And so, and again, the liability of this it's interesting in that it can rely upon, just like I mentioned with the general partnership, it's really dependent upon the partner. But the person making the investment, the limited partner, there is some limited liability for that person. Typically, only their investment in the business is at risk. And so there would be times where that would not be the case, but typically that is what their liability exposure is. And so that's an interesting entity. Again, another pass-through entity that's going to go down to the individual or flow down to the individual's tax return. And again, in this situation, that partnership agreement is required. So it's not just a suggestion. This is a time you would need to do one. So we are going to move from that on to the limited liability company. And with the limited liability company, this is a really interesting type of legal entity that came about in the 90s. And it's really kind of taking the advantages of a partnership and also the advantages of a corporation. And it's really an entity that is easy to, it has a lot of flexibility with it. It has a lot of the administrative oversight or the administrative requirements to maintain this aren't as rigorous as you'll see when we talk about a corporation. So this really is meant to be, it's a user-friendly legal entity because you will be referred to as a member of the legal entity. So you can be a one person or a single member limited liability company, or you can be a multi-member limited liability company. So one person can be a single member. The single member limited liability company or single member LLC will file by default. The IRS is going to look at that entity as taxed as if it were a sole proprietorship. So even though you're an LLC and you're going to file with the Kentucky Secretary of State's office to create the entity, the way the IRS is going to look at the business, they're going to, by default, look at that one member LLC as a sole proprietor for tax purposes. So what that means is at tax time, what you'll be filing is a Schedule C as if you were a sole proprietor. And so if you are a 2 or more member LLC, the default tax treatment is going to be as if you were a general partner. So keep in mind, even though you appear to be having the tax treatment of a sole proprietor and a general partnership, you still have the great advantage of limited liability from the LLC. And so with the LLC, it is, we want you to, when you set that up, you're going to file articles of organization with the Secretary of State. Kentucky's done a really great job of making a lot of the legal entity, the paperwork requirements are now available. All the paperwork requirements are really almost a thing of the past unless you just want to file a paper form. You can go online through the Kentucky Business One Stop portal and create your legal entity. And so I would suggest if you have legal questions about it, you may want to talk to an attorney first. Of course, an attorney can create this for you, but the portal is pretty user-friendly. And so it has a lot of help within it, embedded within it. And if you have questions that come up during the filing process. And so with the limited liability company, it is like a corporation in that the liability is limited. Just like the sole proprietorship or the general partnership, the taxation, the profit and loss of the business will flow through to the individual. So whether that's going to go on a Schedule C or if it's going to go on a partner tax return. Now, what's interesting with the limited liability company is that you have the option, if you want to, of electing a different tax treatment for the entity. So for example, we're going to talk about a Schedule C here in a few minutes as corporation that's a Schedule C. The LLC can elect an alternative tax treatment if it wants to. And this is a particular case when I would want you to have a conversation with a CPA, because the LLC making the election to be taxed as an S corporation is going to complicate things for you in terms of the administrative overhead required for this entity. So you'll be filing a Schedule C tax return, and there will be some other requirements as well. So if that's something that you think you may be interested in, I would definitely suggest that you have a conversation with the CPA just to explore that further, to see if, is this to your advantage to do now, or is there a certain revenue trigger that it would be more advantageous for you to make that election later. But I just want to plant the seed that this is meant to be super flexible in terms of setting it up, in terms of running it. And so even the distributions of profits and losses, if you have a partner in this business with you, you can make distributions of profits and losses. It's not pro rata or based on your percentage ownership. So it could be that one partner wants to take a higher percentage of the profit. Maybe they're in a lower tax bracket and they want a higher percentage of the profit, and someone who is they would be in a lower tax bracket, so they would want a higher percentage of the profit. Someone in a higher tax bracket would want more of the losses. And so you can be very creative when you set it up. There is an internal document that you'll create called a operating agreement. And so that operating agreement will spell out the terms, the distributions of profits and losses. It will talk about, it'll touch on that. It'll touch on bringing in another member. What are the triggers for bringing in another member? What are the considerations around that? So the operating agreement is very similar to a partnership agreement. And again, that is an internal document. So the setup process for the LLC, this is one that you will file with the Secretary of State's office. When you file your articles of organization for this entity, you'll go through that process with the Secretary of State. You'll want to make sure that the legal name that you want to use is available for use, not just in Kentucky, but you would also want to consider and make sure that there's not a federal trademark that's in use for that particular name. So for that reason, some folks are more comfortable filing the LLC and working with an attorney to set it up. But as I mentioned before, you can go through the portal and set that up yourself. So with the LLC, again, it's really meant to be super flexible, a great way to get going in business. The articles of organization are what you're going to file with the Secretary of State. you will encourage you to create an operating agreement for the business as well. And if you're a one member LLC, that's maybe not so much. I would still want you to do I would still want you to do the articles of organization as well for that. But the operating agreement, it would definitely something you would still want to do, because it will address how you will bring, if you want to bring in additional members, you touch upon that when you create the operating agreement as well. So in terms of that profit and loss allocation, it's also going to touch on the management structure, and also rules for meetings and voting if you want to get that formal. But those are the major things that you can touch on when creating the operating agreement. So it's very much like it is the partnership agreement for the entity. It's an internal document. You'll never have to show that to anyone unless you go to court. Then someone may request to see your legal documents. So open it up for any questions you guys might have about the LLC or the sole proprietorship or partnership. And what you'll notice is that we're getting more complex as we progress down the line of different options. And so a question came through: is the article of organization same as articles of incorporation? Yes, in that the article of organization is what an LLC uses to create their entity. If we're going to talk about a corporation next, a corporation uses articles of incorporation. And so they're just the different names for the forms that are used to create these legal entities. So, but that's a great question. So we've talked about the operating agreement for the limited liability company. The contrast for that with a corporation is going to be bylaws. And so we're going to talk about, as I said, we've started off with the very user-friendly, the easy, the informal legal entities, and we're scaling up, getting in terms of complexity. So that's a great question. Thank you so much for asking that. So we are going to move on to talking about the corporation. And with a corporation, I mentioned that the limited liability company is based on state law. And so a corporation is actually created, it's actually created based under the laws of the state, but also there is code within the Internal Revenue Service that was written for the creation of these entities. So that means that a C corporation has its own tax return, as does an S corporation. So we'll talk about that in just a little bit. But with this course, and keep in mind, this is with a lot of the development of this, it was a partnership between the FDIC and the Small Business Administration. And what they want to stress with the curriculum is that most businesses do not need to be incorporated. So, you know, they want you to feel like that by obtaining insurance and using insurance and contracts, that those are ways that you can shield your business from, you know, liability exposure. So they want you to realize that those vehicles are available to you so that you do not have to go through the process of creating a formal entity just for those purposes. So I just want to plant those seeds, and I go back to, it's all about how you feel individually about, you know, risk exposure and liability. And so if you're not comfortable with either one of those, if you feel like there is risk exposure as well as liability and you're just not comfortable with it, for peace of mind, you probably will want to be a more formal entity, whether that's an LLC or an S corporation. We're going to talk about the C corporation first, and just to contrast that with with the LLC. The corporations were really the first type of legal entity that was available to business owners that gave them the ability to limit liability. So before these came into existence, businesses really did not have any way to limit liability exposure. And so when the C corporation started, it was really well received, because at that time, that was the only option available. And so this is a regular C corporation. And we're going to talk about what the S corporation means in just a minute, but there's a couple of things about the corporation I just want to make you aware of. The corporation is the most complex business structure that you could select. And so there is In addition to creating the articles of incorporation, which are required to get it set up with the Secretary of State, you also really do need to maintain bylaws for the entity. So you would need to create bylaws once the entity is established. You also have to maintain minutes, and you have to have annual meetings. And so with those annual meetings, you have to maintain the minutes. And so unlike the LLC, you're not required to have meetings. So you're not required. So there's not a legal requirement or an expectation that you do these things so you can protect the legal entity. So by doing that, what you're doing is you're trying to protect the corporate veil or keep the corporate veil around the business so that someone, someone could say, if you were not, if you didn't have bylaws, if you didn't maintain, the corporate formalities of the meeting minutes and such, if you were ever challenged in court, they would try to pierce the corporate veil. And by doing that, if they were to pierce the corporate veil, you lose all the advantages of being a corporate incorporated business. And so with that means you would go back to whatever the default treatment is. So if you're a single member person or a one person corporation, you would go back to being a sole proprietorship. If you were a 2 or more member entity, you're going to default back to a partnership. So just know that the corporate formalities are real and active for corporations. And so because of that, when the LLCs came about in the 90s, that was a very welcome development because people just did not want to maintain all of the formality and the expense just to get the liability limitations. So with all of the other entities that we've talked about, all of those entities are past due entities. With the C corporation, this is actually an entity that exists separate from its shareholders. So this is a legal entity that does exist. It's a taxable entity. So the profits and losses of the business are taxed. And there's a double taxation issue that comes up when profits and losses are distributed to the shareholders. And so when that distribution happens, the shareholders again have to report that the dividends or the profits from the business, and that is taxable to them. So that's where the double taxation comes in. So that makes a lot of people uncomfortable, but again, back in the day, that was their only option to have any type of liability limitation. And I've touched upon the complexity of forming this and maintaining it. But it is, there are certain times that you have to be a C corporation, that it's a requirement, you just cannot get around it. And an example would be if you were to take a distribution from your retirement plan and to create a business with that distribution from your retirement plan, that requires setting up having a Schedule C entity. So there are certain times where it's unavoidable, but if you have other options, I would encourage you to consider weighing the pros and cons of each one of those options before making that decision. So an S corporation, what separates it from the C corporation is with the S corporation is set up the exact same way as a corporation. The only difference is that there is an election that the entity makes to be taxed differently. So you go through the same process to create the entity, but you're going to file a form with the IRS that says, hey, we want to be taxed as a subchapter S corporation. And so what changes with that, when you file that form with the IRS, they now recognize that for tax purposes, this corporation is a past due entity because it is now an S corporation. And so that is, the main reason that folks would make this election would be for the past due benefit of that and not having the double taxation. And so that's one of the key advantages of doing that, that making that decision in that election. But again, all of the corporate formalities apply. So the bylaws, the meeting minutes, all of those rigorous formalities do still exist and are part of this corporation. Even though it's a past due entity, to really have the benefit of the corporation and the limited liability, you have to maintain those corporate formalities. And so that is generally what draws people to choosing something that's more flexible, like the limited liability company, because they don't want to have the rigors of maintaining the corporate formalities to keep the entity intact and to not pierce the corporate veil. So the question comes about, so how do you, when choosing an organizational type or legal structure, how do you know what's best for your business? And I always tell folks that if you're going through any type of planning process, even if it's an informal business planning process, what I always encourage folks to do is kind of begin with the end in mind. And so think about where you want to be and think about this legal entity, because it's going to be a very foundational piece for your business. It's the very first major decision that you're going to make as a business owner. What you do have the ability to go from a sole proprietor to other legal entities. Once you've made an election or decision to go with one of the formal entities, whether it's an LLC or a corporation, you can still make a change after that point, but it gets more complicated because the business may have more assets, and there might be some tax consequences for making a change to your legal structure. So that's not to say you can't change things. It just becomes a little bit more complicated the longer you're in business, and as the business has grown and it has assets. So there could be a tax implication to make a change to the legal structure. So, just kind of think long-term at the onset, or even where you're at now, assess where you are and where you want to go, and, reflect on your current structure. Is it serving you well? If you're comfortable with it. And additional guidelines that you would want to think about would be things we've touched on already in terms of if you're in a partnership or have multiple owners, how you feel about liability and risk exposure. And, and are you going to be an owner operator, that type of thing. So you'll want to give some thought to those aspects. And, and of course, with large ventures with multiple owners or complex financing, this is definitely when you want to talk to both an attorney and a CPA, because you want the attorneys, again, going to advise you on how to minimize liability exposure. The CPA is going to give you that great advice from a tax perspective and how to minimize that. There's a couple of really good resources that I would point you to, and probably the best source of information on the different legal entity options, if you would want to do more research on that, would be to go to the IRS website. So that's irs.gov would be a great resource. And then the Small Business Administration does have resources available on its site as well, but the IRS is very targeted and specific to the types of legal entities, because they want to make sure that small businesses understand the tax compliance requirements for the different types of legal entities. So they have a lot of great information. And so definitely, if you have questions, the key people to talk to in a situation like this will be an attorney, a CPA, and then an insurance agent. And that agent is going to help you think about, what can we do from an insurance perspective to minimize liability exposure. So those are some things to consider when thinking about and choosing an organizational type. And then the key points to remember is the organizational type that you select. It definitely does impact how you own and run the business. And the example that I would give would be the more complex formal entities like the C corporation or S corporation. That could have, more of an impact on your business because there's more administrative burden for you. So just, that's something to think about. And and also, we talked about your business needs early on and the organizational factors in selecting an entity. So reflect on those and make sure that whatever structure you're leaning towards, that it gives you good coverage or it meets your needs from all of the different factors and considerations we talked about earlier. And again, the most popular legal entity is the sole proprietorship, and so which is the same as the owner. So those are some things to think about. The partnership, we talked about that in terms of the pass-through taxation, the personal liability associated with it, and the sole proprietorship. And planning is a great thing to do in terms of just, even if it's informal planning about where you're at today, where you aspire to go, and just thinking about the structure and if it lends itself to the growth that you want or the operations that you have in mind for your business. So those are some things, the key points to remember as you think about the different legal entities. And so So we've talked about the 5 very common organizational types, and we've talked about kind of their characteristics, what are their advantages and their disadvantages, and then some information about choosing an organizational type. And I would go back and point to the participant guide, has that great assessment in it, and it's got some exercises in it as well that are helpful in terms of evaluating and looking at the considerations around the different legal entities that exist. And so that kind of brings us to a conclusion for tonight's conversation about the different legal structures and organizational types. But I'll open it up for any questions that you guys may have. So if questions come up afterwards, feel free to reach out and we'll follow up with you. And also we would love evaluation. So we'll be sending you an evaluation and we would love your feedback. So we're very open to receive that information from you. So we just thank you so much for attending this with us tonight, especially on a snowy night that we might have some actual measurable snow fall. So thank you again for coming out and just spending some time talking about organizational types. And we look forward to talking to you next week when we're going to look at financial management for small businesses. So wishing everyone a great evening.
Thank you all. Have a nice night.
Bye-bye.